Hello and welcome. My name is Chris Lofrese, Senior Vice President at Gabelli Funds, a global asset management firm founded by Mario Gabelli in 1976. We manage $35 billion in client assets across value, growth, fixed income, and convertible security strategies through mutual funds, separately managed accounts, UCITS, and ETFs. Today, I have the pleasure of moderating our utilities webinar, focusing on the capital investment supercycle that is driving the long-term opportunity within the sector. With me is portfolio manager Tim Winter. I want to briefly highlight Tim's expertise. He is a 3-decade industry veteran that joined our firm in 2009. He has been recognized on Wall Street numerous times for his coverage of utilities. He is the portfolio manager of the Gabelli Utilities Fund, Gabelli Utility Trust, and Gabelli Global Utility and Income Trust. Thank you for joining us, Tim.
Thanks, Chris, and thanks to all for joining us today.
Before I turn it over to you, I think it makes sense for me to briefly introduce the Gabelli Utilities Fund, ticker symbol GAUIX for the Class I shares, as a foundation for our discussion today. The fund was launched in 1999 to capitalize, among other things, on the consolidation opportunity in the broader utility sector, which included telecommunications, as well as to provide investors with a meaningful cash flow solution. With a significant weighting towards small and mid-cap utilities, the fund remains positioned to benefit from further consolidation. But as Tim will highlight today, the surging electric demand driven by AI data centers and the long runway for infrastructure investment add to the compelling overall investment thesis. To capitalize, the fund has strategic allocations to industrials and energy to complement the core utility and telecom holdings. For a cash flow solution, the fund has a fixed distribution policy. This distribution is subject to change by the board of directors at any time, but has remained consistent at 88 cents per share, paid on a monthly basis since the board raised the distribution in August of 2019. Tim, I hope that provides a good background for what you will discuss today, and I turn it over to you.
Great. We're hosting this webinar because we are truly excited about the outlook for utility stocks. The utility investment thesis is becoming ever more compelling. Utilities are growing earnings per share faster than they ever have. They're positioned directly at the intersection of power and technology. Microsoft, Google, Meta, Amazon, OpenAI now measure their data growth in gigawatts, which is a power term, not gigabytes. The U.S. is on the verge of surging electric demand, leading to a super cycle of capital investment. The tailwinds are there for even stronger EPS growth. With all this opportunity, private equity and infrastructure funds are circling the wagons, and consolidation could accelerate. So that's the thesis. The simple thesis is this: earnings per share growth drives utility stock performance, and electric demand is growing. It's going to lead to higher infrastructure investment, and that's going to translate into historically high EPS growth.
So, Tim, thanks for setting the stage. Wondering how is stocks performing year to date?
So year-to-date utilities, depending on what index you use, are up about 20%. This slide here is from September 30th. They've added a couple percentage points since. The sector led strongly in the first quarter. Their defensive nature appealed during tariff concerns and recession fears. Then momentum shifted in the second quarter. Investors were looking for growth and took on more risk, but utilities remain well positioned. They benefit from the AI thesis and from higher growth. So they've become more defensive growth stocks, if you will.
Yeah, that is strong performance that we've seen lately. Can you talk a little bit more about what has changed?
It's electric demand. It's rising at the fastest pace since the 1960s and 70s. Over the past 20 years, electric demand growth was relatively flat. Conservation and efficiency offset any kind of economic growth. But we're on the verge of a power surge. There's a lot of forecasts out there of electric demand, and they all go up. Each successive forecast seems to be higher than the previous one. And this growth is being driven by AI data centers, manufacturing onshoring, and EV charging stations. But the massive AI build out is going to require an unprecedented amount of power to be built out. And This is a slide of the S&P Global Market Intelligence forecast of data center growth. And you can see data center growth is going to go from 45 gigawatts, triple to over 130 gigawatts by 2030. We're in the early stages, and these mega data centers are completely reshaping demand profiles.
Yeah, demand is clearly growing. Can you talk a little bit about who is behind this growth?
Well, there's a race for AI dominance, and the major players are the hyperscalers. It's Amazon, it's Microsoft, it's Meta, it's Alphabet. They need power to win the race. They're trying to secure long term power capacity. These four alone are looking to spend $350 billion on AI infrastructure in 2025. And that's not even to mention OpenAI, Oracle, and others that are spending as well. And just to put this in perspective, the size that we're talking about, 1 gigawatt data centers and some up to 5 gigawatts. 1 gigawatt of power serves about 1 million residential customers. So that's a small city. That's also about the size of your average nuclear plant. So the previous slide, we talked about data center demand going from 45 gigawatts to 130 gigawatts. That's more than 80 small cities between 2024 and 2030. And then OpenAI, Sam Altman, just the other day said he wants OpenAI to have 250 gigawatts of data centers by 2033. That's 250 small cities. So huge numbers.
I like that, Tim. 1 gigawatt equals one small city. Clearly, a lot of demand and a lot of investment. Can we look at some of the individual companies that are positioned to benefit?
Sure. Let's start with one of our top holdings, Wisconsin Energy, WC Energy Group. Microsoft's building a 1.8 gigawatt data center just south of Milwaukee. This is one of the first mega data centers under construction. It's going to come online in phases starting in 2026. The demand from this data center alone increases Wisconsin Electric's peak load by 20%. And as this slide shows, electric demand is expected to grow 4 to 5% from 1% after growing 1% for decades. But this slide's outdated because Wisconsin Energy reported this morning and they put out new slides that we didn't have time to get compliance approved. They actually raised their sales growth to 6.5 to 7%. They raised their EPS growth rate to 7 to 8%, and they raised the load demand increase to 40%. And this is to reflect the second data center here on the left, which is an OpenAI Oracle Stargate data center. And if we go to another holding, American Electric Power, on a bigger scale, AEP is out of Columbus, Ohio. Yesterday morning, with earnings, AEP raised its EPS growth rate to 7 to 9% from 6 to 8%. That's because they expect 28 gigawatts of peak demand through the end of 2030, which is 22 gigawatts from data centers and 6 from industrial load. They raised their 5-year capital program to $72 billion, and they have a waiting list of 190 gigawatts of customers that want to interconnect to the AEP system. I'll move on to Evergy, which is a conservative, somewhat neglected Missouri and Kansas utility based in Kansas City, Missouri. They currently target 4 to 6% EPS growth, 2 to 3% sales growth, but that's under their current assumption of a 500 megawatt build out of signed load. But as you can see on the slide, they have a 15 gigawatt backlog pipeline that they're waiting to bring into budget. We see a portion of this being added either this quarter, they report next week, or by the end of the year. So they clearly have the tailwinds to raise their EPS as well. Then I want to mention Pinnacle West out of Phoenix, Arizona. They target 5 to 7% growth on 4 to 6% sales growth. They benefit from normal population growth, which you would expect in Arizona, but they're also adding 5 gigawatts of large load. Taiwan Semiconductor is investing $165 billion in their service area for 6 huge chip fab facilities. They have another 20 gigawatt waiting list, and they're waiting for a gas pipeline to be built to bring gas from the Permian Basin in Texas into Arizona so this additional load can be added. So you can see there's a lot of tailwinds and a lot of demand growth here.
Yeah, that is a huge amount of power demand. It begs the question, do we have enough power generation?
And that's the question. The power surge has caught most off guard, including the utility sector. Many utilities are reporting waiting lists of large customers seeking to build in their service territories, and they have to wait because there's not enough power. Utilities were in the midst of a long-term clean energy transformation. As this slide shows, since 2010, the U.S. has retired 100 gigawatts of coal-fired power plants, and they have another 80 that they want to retire by 2030. Coal's dirty and it harms the environment, but coal plants are workhorses for the utility sector. In 2024, about 42% of power came from natural gas, 19% from nuclear. Coal has fallen all the way to 16%, and wind and solar now make up about 17%. So this slide, a busy slide, but this is how much capacity, it shows how much capacity the U.S. has as of 2024. We have 1,341 gigawatts. Now we've only added 22 so far in 2025, and most of that is solar. Over the next 3 years, and this is coming from the FERC Energy Infrastructure Update, we're going to add 130 gigawatts of generation, and again, almost all of that is renewables. OpenAI, Sam Altman just wrote a letter to the White House urging the need for more power to achieve AI dominance. That China has added 400 gigawatts in 2024, and the U.S. is going to lose the AI race if we don't fix the bottlenecks. So this is a slide showing that since 1990, we've added primarily renewable generation, a little bit of gas, but primarily renewables. And that's likely to continue as this slide shows that over the next couple of years, the current pipeline of power was put in place by clean energy goals, by climate change, net zero carbon. And we just recently moved to a fossil-friendly environment. So the near-term pipeline is almost all renewables. Manufacturers had quit making gas turbines because they emit carbon. So there's now a huge waiting list for turbines. It takes some time to ramp up capacity. So the point is we're going to have renewables coming online over the next several years, a significant amount. And then come 2930, we're going to see gas plants come online. And hopefully by the early 2030s, we're going to have nuclear come online.
So it sounds like we need more power. Question is, where will it come from?
Right, and that gives me an opportunity to talk about NextEra Energy, which is one of our largest holdings, and it's the nation's largest renewable developer. They're going to add a huge amount of solar and batteries over the next few years, and they're going to benefit from this slight power shortage in a better pricing environment. So they also have an agreement with GE Vernova for gas turbines. And just this week, on Tuesday, they signed an agreement with Google to restart an Iowa nuclear plant. So NextEra is going to be a big beneficiary of all the renewables that come online and eventually the gas. Which brings me to the next topic, the nuclear renaissance that we're hearing all about. Nuclear power is great. It offers around-the-clock reliability, zero carbon emissions. The president is pushing hard for new nuclear. This week, he announced an $80 billion partnership to get reactors built and under construction, to get them under construction by 2030. The hyperscalers all want the zero carbon reliable power. The challenge is that a nuclear project, a new nuclear plant, is costly and it takes years to bring online. The last two that came online, Vogels 3 and 4 in Georgia, went well over budget, took over 15 years, cost $30 billion. And so, the future is perhaps SMRs. But again, the time frame and costs are uncertain. We think a conservative way to play the nuclear renaissance is Constellation Energy and Cameco, which we own in the fund. This slide is the power stack. It's prices by power plant type. You can see that wind and solar is cheap, but it's intermittent, meaning renewables only work when the wind blows and the sun shines. Combined cycle gas is the most practical. It's cheap, proven technology. Combined cycle gas can run over 70% of the time. We have an abundance of gas in the United States, and that's likely to be the future. You can see that after years of underinvestment, and we didn't add any natural gas in 2024, that we are going to start adding it. You can see these green bars start to go up as gas plants are on the drawing board. If we could go out a few more years, you'd see very tall bars there, a lot of natural gas coming online. Here is another example. Gas continues to rise in the forecast of supply, and wind and solar is going to continue to come online. Which brings me to my next national fuel gas, which is our largest holding. With all this gas development, NFG is going to be a beneficiary. They own 1.2 million acres in the very prolific Marcellus and Utica shales. Pennsylvania and Ohio are going to be data center hotbeds, and they're going to be able to, a huge amount of reserves. They're going to be able to power a lot of these data centers and power the gas that's going to come online, the gas power generation that's going to come online to serve the Northeast. As gas prices go higher, they generate even more free cash flow. I also want to just quickly add that utility scale batteries are going to be a growing part of the equation. But back to the investment thesis. Utilities are trying very hard to keep up with demand. They're responding with record capital investment. We're embarking on a super investment cycle that's going to go on for years. In 2025, utilities are going to spend $215 billion, which is 24% higher than 2024. Over the last several years, the 10 years or so where we've had rising capital investment, was primarily due to climate policy and aging infrastructure. The growing capital and record capital expenditures we're going to see going forward are primarily related to meeting surging demand. And to reiterate, the more we invest in infrastructure, the higher EPS growth. So the next question might be, can utilities fund this level of CapEx? But first, I want to point out, utilities want to fund this level of growth. The more they spend, the more they earn. They're fundamentally strong companies. The credit rating agencies take into account their low risk profiles, monopoly service areas, regulatory protections. And so they almost all carry very high investment grade credit ratings. The balance sheets are strong. Importantly, equity issuances are accretive to earnings per share when they issue stock above book, and the PUCs allow returns on investment. Utilities earn returns when they file rate cases, and rates are set based on an allowed return on equity. This slide shows the number of rate cases over the last few years rising, that the allowed profit levels or the allowed ROEs are 9 to 11%, 9.8%. They do tend to be correlated with interest rates. And another key point is that the policymakers and the regulators, they support the investment because they want the economic growth and they want clean energy. So back to the EPS growth chart. In the 1990s, when I first started covering utility stocks, they were growing earnings at 3 to 4%. They weren't necessarily stair-step. We've moved over the years to higher levels, and currently, most utilities are guiding towards 5 to 7 or 6 to 8% EPS growth rates, and those numbers continue to rise. Again, we're early in third quarter earnings season, and the question is, who's going to be the next to raise? In the last 2 days, as we mentioned, AEP raised to 9% from 6 to 8. WEC, Wisconsin Energy, raised this morning to 7 to 8%. NiSource also raised to 8 to 9%. So with all of this spending and rate cases and earnings per share growth, profits, your next question is probably going to be, isn't affordability an issue? And yes, it is. Affordability is making headlines. This graph is from, I think, last week's Wall Street Journal article. The utility bills are becoming a campaign issue in some states. New Jersey is one. Affordability has always been an issue, and it remains a concern and a challenge. But data centers in this large load is likely to help customer bills. These two charts, slides, if you will, I took from PG&E and Excel Energy, and they both show that how adding data center or large load leads to customer savings because the fixed costs are spread over higher sales numbers and higher electric demand. So the other point is the utilities are being very careful in making the hyperscalers pay their fair share when they're adding data centers.
We certainly like lower bills. On that note, we've always discussed economies of scale as a driver for consolidation. How does that play out given the rising level of investment in the space?
Great question, Chris. And if you ask our chairman and lead portfolio manager, Mario Gabelli, about this fund when he started it in 1999, he would tell you that the utility sector was ripe for consolidation. And over the past 25 years, the sector has seen over 120 utility mergers. Consolidation did slow during COVID and because of higher interest rates over the last couple of years. But in the current environment, the infrastructure funds and private equity, they want to invest in this AI energy infrastructure thesis. The smaller utilities want to get bigger because they want to serve this large load. So if we just look at some of the announcements in August, Black Hills and Northwestern Energy agreed to a merger of equals. Blackstone in May agreed to buy TXNM Energy, that's Texas and New Mexico. Constellation Energy is going to close its acquisition of Calpine shortly. BlackRock, it's going to close its pending acquisition of Elite. Elite is Minnesota Power and Light shortly. So, again, utilities are scarce. They're highly valued assets, and they offer a footprint for the private equity and infrastructure funds to further investment opportunities. So there are a number of ways and themes to play the AI power infrastructure build. Here's a number of them: nuclear power, merchant power, data center growth. There's data center utilities. There's significant growth in Texas and Florida. We have takeover candidates, and we have gas demand. We believe that the Gabelli Utilities Fund is very well positioned to take care of these themes. The fund is unique, as Chris mentioned, in that it pays a monthly cash distribution, but also it's more diversified than most. The prospectus from 1999 defines utilities as not only electric, gas, water, and telecom, but also industrial and energy suppliers to the sector. As such, the fund is normally 75 to 80% in regulated electric, gas, and water utilities, but also there's a 5 to 10% holdings in telecom, 5 to 10% in energy, 5 to 10% in industrial suppliers. We do, as most, but we do bottoms up research, and we like to take advantage of the depth of our research in the energy, industrial, and global sector. We tend to own more small to mid cap names, high quality names with earnings growth, but could be takeover candidates. And if you look at the portfolio composition, the S&P Utility Index only has 32 names. The top three make up over 30% of the index. We have over 200 stocks, so very much more diversified. Here's our top 10 holdings. We went through the top five during our discussion. And, just to summarize, we are very excited about the future of the utility sector. We're actively trying to position the fund to benefit from this power surge and from the super investment cycle. Thanks, that, Tim. I'd like to open it up to any questions, if there are any.
Sure. Thanks, Tim. That's a fantastic overview. And listeners will have to take my word for it, but this is the most excited that I have seen Tim in the time that I've worked with him. So very excited about the sector. We have some time for questions. We did have some submitted already. If you have additional questions, please use the Q&A function on the bottom of the Zoom. Let's start with some that we have here already. So sticking on the AI theme, What is the risk for utilities if there's delay, poor execution, or potentially even lower investment around the data centers?
Great question. And I'll answer it in a couple of ways. But first, utilities are being very careful in how they're structuring contracts with data centers. They don't want to end up with huge empty pickleball courts, if you will. They're negotiating special tariffs between the data centers and getting this approved by regulators. They're take or pay contracts with the requirement that the data center would pay stranded investments. And also, they only have so many resources to allocate, as we talked about, a waiting list to get in the service areas. So they're going to only contract with the most desirable companies and clients, and leaving the less desirable on the waiting list. And that said, there are some higher beta names exposed to the data center AI build, and that would be the four non-regulated power merchants. But the regulated utilities, I think there's not that much hype in their valuations. Certainly, if there was a crash in the whole AI theme, you'd get some momentum taken out of the valuations. But they're being very careful in how they position themselves and trying to take care of this growing load.
Great, Tim. And along those lines, we have a couple questions that follow that theme, and it basically boils down to what companies in the space are most levered to AI, and with that, how much of that is priced in, thinking about PE multiples, and this data build out is kind of a known as the listener put in the question. So how much of that is priced in?
Okay, so the way we look at this is there's a number of waves of beneficiaries. And the first wave, and the most obvious wave, is the non-regulated independent power producers. And there's four of them. It's Constellation, Vistra, NRG, and Talon. And they're the first wave to move, and they're up significant amount. Then the second wave is the regulated electric utilities, which are going to slowly build out and earn on rate base as they meet this demand. Where the IPPs are taking advantage of power markets, selling in competitive power markets. So there's more volatility there. The regulated utilities, that's more of a methodical build, rate based growth. And then the third wave would be natural gas. Gas demand is going to be what fuels this build out of power. And so that would be the third wave, and the exposures would be in that order. And then separately, you have all of the industrial suppliers to all of the to the equipment, to the turbines, to the data center build out.
Great. Thinking about that power generation, let's shift slightly to nuclear. Can we discuss more about the future of nuclear? You mentioned the $80 billion investment. What can be done under that, and what opportunities are there in nuclear?
So everybody wants nuclear, it appears. The hyperscalers, the public, the administration. The problem is nobody wants to take on the risk of building it. So utilities which have experience in building nuclear, look at the history of how long it's taken, and they don't want to take on that risk. So the thought is the hyperscalers, they have huge balance sheets, could take it on. But we'll see how that plays out. And the one thing I do know about nuclear is that whatever timeframes and cost estimates, they're likely to be higher and longer. So that's why we said, I think that the best ways to play right now, Constellation Energy, which owns 25 or so non-regulated nuclear plants across the country, they're restarting 3 Mile Island and extending the life of Clinton to contract with hyperscalers is a great way to play. They'll also be involved because of their expertise in the future of nuclear. They're operating, trying to get their existing plants with greater capacity as well. So that's one. Cameco, uranium supplier, and they also own a joint venture part of Westinghouse, which is going to design and build the AP1000, which is what the president in his $80 billion announcement was targeting. And that's another way to play it. So, and I think over the longer term, some of the equipment suppliers to the nuclear sector, which then you wouldn't be taking on the construction and schedule delay risks. So
Right.
hopefully that.
Yeah, definitely. Let's talk a little bit more about the customer bill, how rate cases are going to play out moving forward, whether, the cost of this build out, how it will impact the customer and why the utilities want to continue to build this out, and why regulators may want that as well.
Right. And affordability, it's always an issue. Lower rates, companies with lower rates tend to do better with regulators than companies with higher rates. So that's one of the ways we're trying to distinguish different investments for the fund is preferring companies with lower rates that are going to do better in the regulatory environment. But uh, the utility managements are very careful in how they're structuring contracts, and the hyperscalers are going to have to pay their fair share, if not more. So basically, we'll be subsidizing to a certain degree the residential customer. So by adding these data centers, it's going to benefit the rest of the customer base. So which is only makes common sense. You spread a certain amount of fixed costs over a bigger sales base, and you're going to get lower costs. And so they're responsible for, like Wisconsin Energy is basically separating the hyperscaler from the rest of the system, and they're responsible for their own infrastructure. They're all doing unique things with regulators to try to make sure that affordability is not only addressed, but that this is beneficial to their whole customer base.
Thank you. And let's move to a slightly different topic here. Thinking about interest rates, we obviously had the Fed decision to reduce by a quarter point. How do how are utilities impacted by interest rates?
Well, lower interest rates help utilities. A lower yield curve, in many ways. I mean, one is just their dividend yields, compared to treasury yields. The lower the rate, the more attractive they look. Number two, as we saw, utilities are going to invest a lot. They need to raise. They're going to do it 50% equity, 50% debt. So they're going to be raising a lot of debt. The regulator does allow the cost of debt to be recovered in a rate case, but the lower the cost of capital, the better, the easier it is on the affordability side to get that into rate base. So lower debt costs help, and then just the overall valuation is helped by lower interest rates. So lower yield curve is very beneficial to the utility sector, as it is to most sectors. The other thing I'd just like to point out is that utilities are not bond proxies. I know they often use them for that. Some use them for that, but utilities are growing earnings and dividends, as we saw, at mid-single digit rates. So every year the dividend gets higher, which is not what a bond does, obviously. They're valued on their on their earnings growth, and secondly, their allowed returns are a function of interest rates. So when interest rates go up, their allowed ROEs will go up. If you go back to the 80s when rates were 15%, you saw allowed ROEs up to 18 and 19%. And so there's the offset there as well.
Okay, I think we have time for one more question here. And this goes along the lines of what you were just talking about. We talked about the growth potential for utilities. Can we get back to the defensive appeal and why utilities are sometimes looked at for that?
Yeah, and thanks for that question, Chris. because utilities still do have all of the defensive characteristics. Despite the huge sales growth, they're still monopoly service areas. They're still regulated by the regulators. So if their earnings fall, if their profit levels fall, they go in for a rate case. They're able to recover the cost of the investment, and their products, electricity, gas, water are pretty much necessities. So all of those things, the credit rating agencies take that into account. So they all have strong balance sheets and credit ratings. So they do remain very, very defensive. But they just have a growth element now that more so than they ever had.
Perfect. That was great, Tim. For the questions we didn't get to, you can find my contact information as well as Tim's on the website. Feel free to we invite you to send those questions directly to us. And with that, I also invite our listeners to check out the insights section of our website where they can find Tim's latest white paper covering this topic. On the insights section, you'll also find additional market topics covered by our dedicated team of analysts and portfolio managers that conduct fundamental bottom-up research using our private market value with the Catalyst investment process. There, you'll be able to also find information on all of our investment solutions, including the Gabelli Utilities Fund. And again, ticker symbol for the Class I shares, GAUIX. And you can find the contact information for your entire Gabelli team. We thank you all for joining us today. Tim, we thank you for the timely update.
Chris, thank you. And thank you all for listening.
Returns represent past performance and do not guarantee future results. Due to market volatility, current performance may be lower or higher than the performance data quoted. Investment return and principal value will fluctuate, so, upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 800-GABELLI or visit www.gabelli.com. Funds investing in a single sector, such as utilities, may be subject to more volatility than funds that invest more broadly. The utilities industry can be significantly affected by government regulation, financing difficulties, supply or demand of services or fuel, and natural resources conservation. The value of utility stocks changes as long-term interest rates change. The fund may invest in foreign securities. Investing in foreign securities involves risks not ordinarily associated with investment in domestic issues, including currency fluctuations, economic and political risks. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about these and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. Gabelli mutual funds are distributed by G. Distributors LLC, a registered broker-dealer and member of FINRA.